The Federal Reserve has wrapped up 2018 with a key interest rate hike, the fourth such increase this year and another dent in the wallets of American borrowers. Savers, on the other hand, will earn slightly more on the money in their bank accounts. Interest rates on credit cards, adjustable rate mortgages, home equity lines of credit and some student loans are likely to rise, experts say, increasing borrowers' monthly payments. All have variable rates that directly respond to the Fed's move. Loans with longer fixed-rate terms don't follow in lockstep with the Fed rate hikes, but generally and gradually move in the same direction. The Fed lifted its benchmark short-term rate by a quarter percentage point to a range of 2.25% to 2.5%. It's the ninth bump up of the key rate since late 2015. They're accumulating and the total impact is large, says Tendikap Fidesi, chief economist of LendingTree. You need to stay on top of it. Here's how the moves could affect you. Credit card holders' credit card rates are generally tied to the prime rate, which in turn is affected by the Fed's benchmark rate. Expect to see a higher credit card rate within 1 to 2 billing cycles, says Greg McBride, Bankrate's chief economist. Average credit card rates are 17.6%, according to Bankrate. For a $10,000 credit card balance, a quarter-point hike is likely to add $2 a month to the minimum monthly payment, says Nick Clements, co-founder of Magnify Money, a personal finance website. The cumulative effect of 9 hikes since late 2015 is an extra $18 a month, says McBride. What you can do, if you pay your balance off every month, you avoid interest charges altogether. If you're staring at hefty outstanding balances, consider consolidating those into a lower, fixed-rate personal loan or transfer to another credit card offering a 0% rate for an introductory period. This not only insulates you from further rate hikes, but gives you a good tailwind toward getting that debt paid off once and for all, McBride says. Home equity borrowers: if you've tapped your home equity, it'll be more expensive to pay back. Most home equity lines of credit, or HELOCs, also track the prime rate. Similar to credit cards, the rate increase will take effect within 30 to 60 days. Rates for home equity lines of credit are much lower at 6.27%, Bankrate shows. A quarter-point increase on a $30,000 credit line raises the minimum monthly payment by $6.25 a month. What you can do: McBride recommends asking your lender to fix the interest rate on the amount you've already borrowed. Future rate increases would only apply to additional borrowing. Or, refinance into a fixed-rate home equity loan or refinance the HELOC with another lender offering a lower, intro rate. Homeowners: unlike credit cards and HELOCs, rates on adjustable rate mortgages are modified annually. So the impact of the Fed's rate increases may hit at once. If you have a fixed-rate mortgage, you are not affected. Hikes this year have pushed up average rates by about half a percentage point to 4.04%. That has increased the monthly payment on a new $200,000 mortgage by about $70, according to Magnify Money. What you can do, if you're worried about future rate hikes: talk with a mortgage banker about refinancing into a fixed-rate home loan. The monthly payment may be higher initially, but won't budge in the long term. Homebuyers: the Fed's key short-term rate affects 30-year mortgages, the most common purchase home loan, and other long-term rates only indirectly. Those rates more closely track inflation expectations and the long-term economic outlook. The average 30-year fixed mortgage rate has already climbed from about 4% in early January to 4.63%, largely because investors expect federal tax cuts and spending increases, along with a healthy economy, to push inflation higher. Wednesday's rate increase is already baked into mortgage rates. For home buyers, any impact on the monthly bill would probably be relatively small. A quarter-point rate increase on a $200,000 mortgage would boost the monthly payment by about $30. Other Fed moves could also play a role. A year ago, The Fed announced that it's gradually shrinking the bond portfolio it amassed during and after the financial crisis in a bid to lower long-term rates. That likely has a greater effect on fixed mortgage rates. What you can do, once you're in contract to buy a home, lock the interest rate to protect against any future moves higher. Otherwise, focus on improving your credit score and paying down other debt to help you qualify for a better rate. Car buyers' monthly payments on a new auto loan also could edge higher, though many buyers might not feel it because of auto dealer incentives. 5-year auto loan rates currently average 4.93%, according to Bankrate. A quarter-point rate hike theoretically would get passed on to new auto loans, increasing the monthly payment for a new $25,000 car by $3. Existing loans would be unchanged. What to do? Look for deals. Auto manufacturers frequently offer discounted financing to encourage car sales, and banks and other lenders compete with those rates, Cap Feinze says. Student loan borrowers. Many private student loans come with variable interest rates that follow the prime rate. When the loan rate adjusts depends on what's written in your loan terms. For instance, your monthly payment will increase for those on a regular payback schedule. But if you're on an income repayment plan, your monthly payment won't change, but a bigger portion will go toward interest rather than principal. Federal student loans have a fixed interest rate set by Congress and are not affected by the Fed's move. What you can do: compare offers to consolidate your private student loans debts into one at a lower interest rate. Subversins banks will be able to charge a bit more for loans. They'll have a little more leeway to pay higher interest rates on the deposits customers make. Don't expect a fast or equivalent rise in typical savings accounts or CD rates, many of which pay interest of 1% or less. Those rates have barely budged the past year despite the Fed's hikes. Low rates on loans have meant narrow profit margins for banks for years. They can now benefit from a bigger margin between what they pay customers in interest and what they earn from loans. And since they're still flush with deposits, they don't need to attract more to make loans. What you can do: a handful of online and community banks, credit unions and money market mutual funds that are hungrier for deposits are paying as much as 2.8% on a 1-year CD, up from 2.15% in March. And top savings and money market rates are at 2.4%, up from about 1.4% a year ago, McBride says. For the first time in a decade, savers can actually earn a rate that is higher than the rate of inflation, McBride says, but you have to shop around. Most big banks are still pretty stingy with their payouts,